With world-class expertise and local insight, Dexus creates value, not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Good to have you with us as we wrap up, Friday and the week. And what a week it has been. Of course, we cast our thoughts back to last weekend where China and US trade officials met with low expectations that anything would be hammered out. Well, in fact, of course, as we all know, they pulled way back on those tariffs. Mind you, no deal has been set at this point. They do have 90 days to do that. As a result, of course, we did see very much a risk-on sentiment across the course of the week, and that played out again today locally as well. Looks like we're going to finish up around 0.5% higher on both the CBA 200 and ASX 200. A bit of a pattern having emerged across the week, in fact, where we burst out of the blocks and then lose a bit of momentum across the day, and so it played out that way today as well. Just taking a look, in fact, at some of those sectors that have moved. Actually, the REITs, the best performance today, up almost 2.5%, that sector, perhaps with the prospect of rate cuts coming here locally, of course, next week with the RBA meeting for its May meeting on Tuesday. Just getting to the three themes of the day. CBA record high. Well, it was brief. Nonetheless, it was another record. In fact, those shares, CBA hitting $173. Looks like it actually might finish back in the red to finish the day. In fact, I'm looking at the screen now. It is dead flat. But it continues to surprise, doesn't it? In that it just keeps moving higher and higher. Now, another big mover across the week has been gold, coming off substantially, obviously, as it was a very crowded trade. Many investors unwinding that as they took on more risk and dumped the safe haven, but made a bit of a comeback today with those gold miners, perhaps the best performers on the bourse today. And I mentioned RBA Tuesday. Yeah, that is ahead, of course. Next week, expectations, the central bank will be cutting by 25 basis points, although a bit of hesitation there, particularly among some economists, given that, in particular, that jobs data, which came in way ahead of expectations yesterday. Okay, so let's get to those sectors that have moved today. I was talking about CBA, so let's see how the big banks have finished. Just in mixed territory there, mentioning there that CBA pretty much flat on the day. ANZ and Westpac off slightly. NAB, the pick of the bunch there. Macquarie also down by 1%. In terms of the REITs, that is the best performing sector across the day, led by Scentre Group and Goodman. Whereas Dexus having some issues, just in matter of disclosure. I'll get to that in just a moment. And elsewhere, gold coming back, but those gold miners have fallen a lot across the course of the week as we saw the gold price come off. It does, of course, remain above 3,000 US dollars. It was back up to about 3,200 odd overnight, so that hence saw that reversal as far as the gold miners are concerned. Getting to some of those top stories, Rio Tinto is set to invest $1.9 billion to modernise its hydroelectric power plant in Quebec, Canada. Webjet rejecting a $314 million offer from private equity firm BGH Capital for a controlling stake. Night Entertainment Director Samantha Lewis stepping down from the board after 8 years. Capricorn Metals Chief Executive Paul Criddle resigning from the top job despite assault charges against him being dismissed in a WA court. And the Chief Executive of Fletcher Building's Australia division will depart the company as part of its ongoing strategic review. Monadelphous sitting a 5-year high on $115 million worth of contracts, and ECS Botanics rising on upbeat annual outlook. Dusk Group seeing its worst day in 2 years on weak margin outlook. Comms Group gaining on a $6.4 million Tasma net acquisition. Well, another big mover today was App, and that is our stock of the day. To get across it, Adam Dawes from Shaw & Partners and Mark Garner for MPC Markets.
generating a lot of revenue growth from their AI, and that's definitely a major driver for the revenue. The EBITDA is improving and costs remain in control. They've gone fairly bullish on that guidance. But on a long-term chart, it's got a long way to go. Now it's really moved into that AI modelling, and that's really driven the growth going forwards. So potentially this is one that you can then start to get stuck into, and hopefully it starts. I'm going to say it's a hold from me.
They're continuing to invest in automation and prototyping and testing the large language models. If they can pull that off, then I'll be interested in this stock. And I think the guidance is extraordinarily bullish. And if they keep relying on the old model, I think this goes to zero, basically. I think they're in a hell of a lot of trouble because, they've lost their big customers as well. So worth keeping an eye on because they are going in the right direction. They have changed their business model. I'd be selling and waiting to see how they go next update and keeping a really close eye on the updates because there could be a lot of upside in it if they do pull that off.
Let's now wrap up the week, and to do that we are joined again by Shane Oliver from AMP. Shane, welcome back, good to see you. So it's been some really impressive moves on equity markets this week off the back, of course, of what came out of that meeting in Switzerland last weekend between the Chinese and the Americans with, what do we call it, trade détente? Because, I mean, they actually haven't come up with a deal. It's merely a 90-day reprieve.
That's right. It's hard to call it a deal. As you say, it's a détente. It's a pause to allow negotiations to occur. And then, of course, at the end of the 90 days, if nothing's happened or no improvement from the US side, then I guess tariffs go back up again. What they go back up to is anyone's guess. It's fairly similar to the pause that Trump applied globally about a month earlier in relation to all countries where reciprocal tariffs had been imposed above the 10% level. So it's not really a trade deal as such. No concessions were given on either side. Obviously, we're still up in the air as to where it may end up. But the fact is, Trump has backed down again. It is a sign that he is sensitive to what the share market is doing. There's still a Trump put out there. He's sensitive to the bond market. He's also sensitive to the US economy and complaints from American consumers who, most Americans say trade is good and they don't want to see their prices go up. So I think it's a good sign, but obviously we're left with, depending on how you look at it, 60 days remaining for the rest of the world and 90 days in relation to China, or a bit less now, to see what happens in all of this. So that uncertainty is still there.
I think I mentioned this last time, Shane. We should really pay more attention to Donald Trump's social media posts because he gives a good indication of when stocks are going to go up, doesn't he? He did that last week ahead of that meeting. Lo and behold, look what's happened on share markets this week. That's
right. I think he said buy, something to that effect. It's a bit dodgy in a way.
No, just a bit.
Just a bit. But, that's the nature of this president. Earlier this year, before he was inaugurated, he and Melania put out those meme coins. And of course, he urged everyone to get in. Of course, most people would have got in at the top and lost some money on that. Now, of course, the Argentinian president, Milei, did the same thing, and he got into a lot of trouble. But of course, Trump just walks away, no worries. One of these days, some of these things could catch up with him, and there is an issue around that share comment. And I think there's been a few more since, so that could be an issue. But anyone can tell you that if the tariff levels were going to be cut, then that would be positive for share markets, and it certainly was. Trump obviously knew that was about to happen, and lo and behold, up goes the share market.
Well, I guess Donald Trump makes the point he's very transparent. You don't have to look at that gift from Qatar in terms of his new jet. Shane, right. Just in terms of what we've seen though on the share market, how would you describe those moves? Whether perhaps it is a bear market rally or we're back in bull mode?
Well, you don't quite know at this stage. It could be another bear market rally. We saw going into the GFC several huge rallies along the way, and then of course the market resumes its downswing. It has been quite impressive, the rally. The US share market's now within 4% of its all-time high. Aussie shares less than 3% away from an all-time high. So that's certainly been a good rebound. More than it's about 80% of the slump has been recovered. So that's good news. And recently we have seen, particularly when you look at the all-important US market, which sets direction here, we have seen an improvement in the quality of the rally with more cyclical stocks participating in it, which some would say is a good sign and a sign that we might break out to new highs, and we may well. But by the same token, we are still looking, like even if the tariffs are frozen where they are today, if that's where the end point is, it's actually about 40% on China if you include fentanyl and the existing starting point and the reciprocal tariffs, plus 10% on the rest of the world, plus the sectoral tariffs, 25% in most cases. That gives you an average of about 14%, a weighted average of 14%, which is about 5 times where we were at the start of the year and well above what most economists, including ourselves, had been expecting it to settle at. So if we stay at that level, it's still going to be a drag on economic activity. There's still uncertainties for the Fed as to when they can confidently start to cut rates again, even though we have got some better inflation data lately. And you've still got this other problem lurking in the background that we're starting to see increasing focus on the tax cuts from Trump or the administration. They're working their way through Congress, the extension of the 2017 tax cuts, plus a whole bunch of other tax cuts on top of that. And as that goes through, it will cement in the bond market's minds concern about the budget deficit, particularly now that we're going to get less DOE savings and less tariff revenue. So that means the budget deficit could become more of a concern. And that possibly explains why bond yields have gone back up again, which in turn will possibly act as a bit of a constraint on how far shares can go. So I suspect it's still going to be a bit of a volatile ride for a while yet before these things settle down.
Yeah, that's that big, beautiful bill that it's got before Congress, which, still going to get through Congress, of course, but as you point out there, adding potentially trillions to the debt position of the US. Look, Shane, I mean, we have seen some weakness in the US jobs data. What about locally, though? Particularly with the point of what we saw yesterday with those jobs numbers. What do you make of that?
Well, it's almost at the point where, I kind of think, well, what's the point of looking at the jobs figures when they come out in Australia? It's a bit of a random walk as to where they're going to go. Either you get an upside surprise like we did yesterday, 89,000 new jobs, or only a few months ago for the February numbers, a downside surprise when there was a 56,000 fall in employment. On both occasions, it's put down to changes in participation. Back in February, a whole bunch of 55-year-olds and older were suddenly retiring or leaving the workforce. The most recent number, a whole bunch of 35 to 44-year-olds were coming back into the workforce. If you abstract from all of that, the unemployment rate has gone basically sideways at 4.1%. So I think we have to put the headline job number aside. It's incredibly volatile, likely to remain so. Focus on the unemployment rate. It's still low. It still tells us the labour market is tight. But it's no tighter than it was before we got yesterday's numbers. So that's telling us that things haven't really changed that much. So I don't think it should be a factor influencing the Reserve Bank's thinking, at least not in terms of what they were previously thinking, i.e. the jobs market is tight. It's still tight, no tighter than it was. And therefore that you could argue was an argument to leave rates on hold, but all the other factors, I think, point to rates being cut.
I mean, I do note that some economists out today saying, look, that a rate cut next week is no longer 100% certainty, but you don't feel as though then there's going to be any measure of hesitation amongst the board members?
I'm sure there'll be some debate about this. The money market has gone from, well, if you go back to just after Liberation Day, I think the money market had 50% chance of a 50 basis point cut, 100% chance of 25, 50 on a 50 basis point cut. That's prior to the wage numbers and the jobs numbers this week. That's now that had fallen to about 105%, so 5% chance on a 50 and 100% chance on a 25. Now it's 0 on 50 and about 95% chance of a 25-point cut. So the money market's almost saying 100%, but there is obviously some risk in there that the Reserve Bank may decide to do something different. I think most economists are looking for a cut. I think there'll probably be a few out there who aren't, one or two, but as far as I can tell, most are looking for a cut. So I'd say it's about maybe not a 95% chance, but it's a 90% probability they will cut. What I think will be most interesting, though, is the commentary that they put out, which I think will be potentially leaving the door open for a further cut, but not committing to it. In other words, the Reserve Bank will remain fairly cautious in terms of their guidance, for the simple reason, you've still got a relatively tight jobs market, and they're still concerned about weak productivity growth. But when you look at the inflation numbers, they're falling in line with their expectations. The wages growth number was also in line with their expectations. They're probably going to have to revise down their growth forecast because consumer spending looks like, based on the data we've got so far, looks like it was flat in the March quarter. And there's still a big drag coming. There's still uncertainty coming in terms of the impact of the trade war, tariff war on Australian growth. So I think for those reasons, I'd say 90% chance of a cut, but there is that small 10% chance they might decide to hold. More likely they will cut, but they'll issue cautious guidance.
Well, Shane, I look forward to dissecting that decision this time next week. In the meantime, thanks for joining us. Have a great week. Thanks for joining us on AMP. Cheers. All right, let's now take a look at those leaders and laggards as we wrap up today and the week. And some of those stocks that have been hit hard more recently, making a bit of a comeback. Certainly the gold stocks, among them Bellevue and Genesis, the best picks there. Also Liontown Resources, some of those lithium players are back as well. Whereas the uranium miners are heading in the wrong direction today. And in fact, Paladin down along with Boss and Deep Yellow fairly heavily there, over 8%. And in the smaller space, well, we did mention Appen rising more than 17% off the back of its upgraded guidance. Their energy resources also rising by 33% of note today as well on the negative side. Some of those energy stocks falling. Theta Gold Mines is the outlier there. It's come off today. Let's head to what we can look forward to overnight, our time. US housing starts, also building permits there for April, as well as import and export prices. It's going to be interesting to see whether we see any flow through, particularly as far as those tariffs that were at eye-watering levels prior to the beginning of this week. And ahead next week, of course, it is the RBA decision on Tuesday. We also get some further updates, among them James Hardie and Wesfarmers, and a global read of PMIs there on Thursday. Righto, let's recap where we're finishing then. Let's call it 0.5% higher on the CBO. Similar moves there we've seen on the ASX 200 to finish around 1.25% higher on the week, remaining more than 3% off its yearly high. That is the COB for today and for the week. Thanks for joining us, and we'll do it all again next week.